All right. Hey there, everyone. It's Kevin, and this is another video lesson for you. This particular one is going to get pretty deep of all the lessons, I would say. If I had to pick one lesson that's going to get the most deep, it's going to be this one. And specifically because I'm going to be talking about intrinsic and extrinsic value, I think it's one of the key components, and it's the key lesson to really understand and get your mind around, and perhaps hopefully, since I had such a difficult time with it when I was first starting out, I'll be able to articulate and give you a little bit clearer definition and descriptions of it, so you don't have to struggle as much as I did. But realistically, if you can just think, options are a decaying asset. There's a time element to them. One of the first lessons I said the options are all about time. That is all they are about. You are trading time, and you need to understand and process that fact, because the longer you're in a trade, the more it's losing its time value, and that either works to your advantage or to your disadvantage. If you are selling something, you want that time value to erode faster, because that means that you generate profits faster. Okay. Conversely, if you are an option buyer, you want that time decay to go slower, right? I mean, it's all about how you're positioned. And the last lesson I talked about directional and non-directional trading. Well, those elements are in there. If you're directional trading, you want price to move, and you want the price movement to kind of overtake and overwhelm that time decay so that you make money on the price moving. Versus non-directional trading, you don't want price to move. You want that element of time decay in your favor so that you can make profit by that. Okay, so managing your inventory of your option trades, you want to be thinking about how they are valued. We are trying, if we're just talking about straight out buying puts or buying calls, if you buy a put, you want the market to go down. If you buy a call, you want the market to go up. And what makes that profit, I'll bring over, this is a really good site. Gives you some good introductions, some call option basics, option premiums, things, how to calculate. To make money on that inventory, that product, if you will, this value is what you're looking at. So you need to know what your option is valued at, so that if you are buying something at wholesale and you want to sell it at retail, well, that difference is your profit that you keep. So the cheaper you can buy an option, the better, as long as you can sell it for a more expensive price later on down the road. Okay, well, that value, if you will, is the intrinsic value of the option, and some options will hold their intrinsic value all the way up until the day of expiration. Okay, remember there are three components, or there are three characteristics of trading options. You've got your option price, you've got your strike price, and you've got your expiration date in time. It can be as short or as long as you desire, but this value that I keep talking about, that value of the option trading, what it trades for, that's further separated into intrinsic and extrinsic value. Okay, so this right here is going to talk about intrinsic value, and your in the money options, your at the money options, the moneyness of the option. All right, all these terminologies and all this vocabulary. You can spend some time reading here. For me, it's easier for me I'll just bring over the platform and I'll show you what I'm talking about, so that way maybe it'll make a little bit more sense. If I'm looking at an option ladder here, an option chain, right, and I'm going to look at, let's just, I want to go into a chain where I don't have options, because I don't want to I want to make things as simple and as clear as possible. This option right here in April, there are 73 days until this option expires. I'll just do this. I'll go to Apple. I'll go to underlying I don't have a position in. So there are 46 days until March options expire. All right. So between now and the third Friday of March, now let me just briefly pause, and I want to show something to you. The red strikes are the weekly options. The white ones are the monthly options, and that just means that the third Friday of every month, these options expire. And if you look at that on a calendar, right, it's always going to be highlighted in Thinkorswim. So February 20th, the February options cycle expire. March 20th, April 17th, May 15th, June 19th. The third Friday of every month, the monthly options expire. This whole entire week is called Options Expiry Week, or OPEX. All right. If you ever see that phrase OPEX, that's all it refers to, is Options Expiration Week. 68% of the time, this week is bullish, and 68% of the time, this date is bullish. And there's some statistic on why that is, and I don't know. I'm not going to go into all that, but just know that traditionally speaking, this week and especially this day, more often than not, more than 50% of the time, it's always going to be a bullish trading day. And so, when you want to start putting that into your knowledge base about how options trade, just understand that last day, that last Friday, when they trade, that's usually when they are the most active, and a lot of positioning happens, and a lot of movement happens on those expiration Fridays. Not always, but most of the time, you're going to have big market moving days on those Fridays. So that's I just wanted to point that out, because why some of these are white and some of these are red. Okay, so these weeklies expire every Friday. The white ones only expire the third Friday of the month. So let's go to March. These expire March 20th, so you've got 46 days until these options expire. This 100 is just the 100 multiplier, so if you want to buy this option right here, it's going to cost you $600, all right? That's an automatic 100-to-1 leverage on options, which again generates some of the attraction why people like to trade options, all right? So if I am going to trade this right at the money, Apple is at 117.87, all right? So 115 is the strike that's right at the money. You will notice that if I come right here, the further in the money I go, it's shaded, and it just means that the price that the underlying asset is trading at is higher than the strike price. I'll repeat that. When the underlying asset is higher than the strike price, that generates intrinsic value. Okay? Now, what you'll notice here is as soon as you come out of the money, there is zero intrinsic value. This column right here is all intrinsic value. So that means that this option from right here out on the call side has no intrinsic value. You can buy and sell these, and all you are exchanging is extrinsic value. And extrinsic value is the moneyness of the option, all right? Which means that this is what traders believe the market is going to do. If there's a lot of extrinsic value because there's a lot of volatility, because people think that Apple's going to have a big move right before an earnings announcement or before a news release or any kind of event, then this extrinsic value is what changes either up or down based upon uncertainty or not. All right? That has nothing to do with the intrinsic value. So, it's just the flip for that on the put side. So when you start looking at intrinsic value, what a very, very common strategy is, and I'm not going to talk a lot about strategy in this first introductory course because I really want to keep this at just fundamental, basic, introductory level stuff, all right? But one very common strategy is for maybe traders that don't have a really large trading account is you just trade these options that are deep, deep, deep in the money because there's little, if any, extrinsic value to them. All right, so what you're trading is all intrinsic value, so you know that right up until expiration, this value is going to hold. All right, so you get almost kind of like that one-to-one movement, so you can trade the stock without generating a lot of outlay. Let's just look at Priceline. What's Priceline? Is it $1,000 a share? Something like that? Yeah, 1,009, right? So if you wanted to trade 100 shares of Priceline, right, it's going to set you back 100 grand. Well, I mean, I'll tell you, I don't have 100 grand in my account. I don't. I'm not trading full time. I'm not trading that large of an account. I will someday. I'm not there right now. So if I wanted to trade Priceline, it's physically impossible for me to trade 100 shares of Priceline. My account would not support it. However, if I really, really wanted Priceline and I really, really thought it was going up, I can go deep in the money where there's just a boatload of intrinsic value, and I could say I wanted to buy something right here. Let's say I wanted to buy the 900 strike of Priceline. Well, now I'm controlling the same exact 100 shares, and instead of it costing me $100,000 to control Priceline, I want to show you this risk profile. This is 100 shares. The white line is you know, if you head up, you know, look at the x-axis here. If you head up to the right, you're going to make money. If you head down to the left, you're going to lose money. Well, it's a very similar profile when you go deep in the money. If you head up, you're going to make money. If you head down, you're going to lose money. And the reason for that, but look at the difference in the capital outlay that you need in order to trade that. Now, this is only going to set me back $11,520 to trade the exact same position as I could trading 100 shares of Priceline stock. So that is one way to get long or short an underlying asset if you don't have the funds to do so, and it's purely because this is all intrinsic value. But remember, at expiration, this is going to go to zero, or when the options expires, you cannot trade it any longer. So if you bought it for one price, you have to sell it before the option expires, and that kind of leads me back full circle to that conversation about view your options as inventory. If that was a pair of tennis shoes and you knew that they were going to, I don't know, spontaneously combust in 2 weeks, well, you would make sure you sold them between now and the time they expired, right? And you would want to make sure that if there was a lot of intrinsic value on them, the signed copy of Michael Jordan, one of only 10 ever made type shoes or something like that, right? You would want to make sure that they hold their intrinsic value, so when you sold them, you would get that money back. Versus extrinsic value, this is all time value. There's that word time again. This is all about time. So this time element right here, if I thought that it was going to go up and I didn't want to spend that much money for an option, well, I could go way out here, and let's say I wanted to only spend, $1,100. All right, well, now I'm going to spend $1,000. I'm going to get a much different profile look. Yes, it's still going to gain if we go up, but you see this kind of rounding, sloping pattern? Well, that is because there is no intrinsic value. It is all extrinsic value. Therefore, it is all subject to changes in volatility. Okay, volatility is uncertainty. It's traders' opinions. It's market gyrations. It is, earlier today the Russell was down 6 points. Now it's up 7. That's a 13-point intraday swing. That's volatility. Therefore, you see this RVX that monitors that volatility. We have volatility all over the place. When you trade extrinsic value, you are trading volatility. When you are trading intrinsic value, you are not trading volatility. You are trading price. So God, I feel like I'm not explaining that, but I hope I really am, because when I started out, man, I could not get this. I could not get my head around this for whatever reason. Maybe I'm just stupid. I don't know, but I couldn't get it. I really had a hard time. I struggled with it. So I want to spend some extra minutes on this to make sure that it really makes sense. Those of you that are listening to this, because you'll see that it changes, right? I mean, we're price lines at 10.12, so anything under 10.12 on the call side is going to have intrinsic value. And of course, the deeper under that price you go, the more intrinsic value it has, because you have little, if any, extrinsic value. And it is the exact same on the puts, it's just in reverse. So the puts, remember, you want the market to go down. So if I want a short price line, I think there is absolutely no way in the world it's trading way too high. It shouldn't be this high. I mean, it's gone up too fast, blah blah blah, whatever. And I want to trade it. Well, if I want to short it, right? The same thing. I'm going to have to come up with $101,000 to short this dumb thing, versus, let's say I wanted to go way up here. If I wanted to buy this, well, if I bought this, it would cost me $29,000 to short it at the 1305 strike price. Or I could just come right down here to the 1100 strike price, and I'll pay $9,000 to short it. Right? You get that kind of that one-to-one same type of movement as you do when you short the actual stock. If it moves against me and price line just keeps going up, I'm going to keep losing. I'm going to keep losing until we get to that point to where extrinsic value enters the picture. And that is right in here. When the curve begins to slope, that is your option value that is sensitive to changes in volatility. So when uncertainty enters the picture, which is what happens out of the money, all right, because these are out of the money on the put side, right? Anything under the underlying asset is now out of the money, then that becomes very sensitive to volatility changes. And you'll see that the farther out of the money you go, I have one of my columns here is implied volatility. I mean, you go deep in the money, right? You've got 35, 40, 32, 31. Now, as soon as you start coming out of the money, look at what that starts doing, is that starts increasing. You get all the way out of here, there's, essentially nothing is trading this far out at 600 strike, but that is all extrinsic value. So calls and puts, try not to get them too confused. It's going to take time. And if you've already got this, I apologize. I know that I am hammering this over and over and over again. I'm not trying to be a broken record drone bag of hammer you to death with this, but it's important. It is absolutely important, and it's pivotal to understand and to get. Every option, this price right here, is made up of intrinsic and extrinsic value. All right? So I can see, I go right here at this price. If this is trading at, bid is at 29.30, ask is at 31.10, all right? If I change this column right here to mark, the mark is all extrinsic value. And the mark is just the difference, the midpoint between the bid and the ask. As soon as you go in the money, all right, now all of a sudden, intrinsic value enters the picture, and there becomes less and less extrinsic value. So the price of the option gets more expensive the deeper in the money you go, because now you are buying and selling intrinsic and extrinsic value. All right. So I think that is probably about, I don't know how much more I can explain that. If you need to listen to it again, if you need to watch it again, feel free. I mean it seriously. Send me an email, read up on this stuff, because this is, I'm just going off of my experience, but this was one of the hardest things for me to get when I first started out. And once you get it, it really does. It's like, oh, okay, I get it. That makes sense. Then it's, some of you probably are already like that now. And you're like, shut up already. I get it. Move on. But if you don't, just understand you're not alone. This is, it is difficult to get in the beginning, but trust me, you will get it. Hang in there, and don't give up. All right, if you want this, do not give up. I mean, finish strong and just dig in and just get after it. So, all right, thanks much, and we'll have another one coming soon. Bye.